Okay. Hello. Good afternoon, everyone. I welcome you all to the seminar. In particular, I welcome Dr. Poonam Gupta, Director General at NCAR, to the Mishra Center for Financial Markets and Economy. Just to give a brief background, the Mishra Center undertakes research on financial markets and the economy in the Indian context, but with the global markets as the benchmark. So we facilitate research by IMA faculty and doctoral students working in finance, economics, and related areas. The center organizes seminars, workshops, and conferences. We also engage with relevant regulatory authorities who influence policies as well as industry bodies and other stakeholders. Let me now introduce Dr. Gupta. Dr. Gupta is the Director General of NCAR, and she is also a member of the Economic Advisory Council to the Prime Minister. Before joining NCAR, she was a lead economist, global macro and market research at the IFC, and lead economist for India in the World Bank. So she has also worked as the RBI chair professor at NITFP, professor at ICRIAR, associate professor at the Delhi School of Economics, and economist at the International Monetary Fund. Her research has been published in leading scholarly journals and featured in The Economist, Financial Times, and the Wall Street Journal. She holds a PhD in international economics from the University of Maryland and a master's of economics from the Delhi School of Economics. She'll be talking about the slowdown of the Indian economy prior to the COVID crisis. So with this, let me hand over the floor to Dr. Gupta.
Thank you. So good afternoon, everyone. I met with some of you just now, and we talked about my research. So what I'm going to be presenting today is one paper from my research, which has been on a number of different issues. In the past few years, I've also been working on India's growth dynamism or patterns in India's growth. I have been in and out of India. From 2013 till 2021, I was working in Washington, DC at the World Bank. And last 3 years of which were working on India for the World Bank. So I have been familiar with the Indian economy. But even then, when I came back as a part of my new job, I was often asked about my forecast of growth for the economy. And a few times I said, well, we don't do growth forecast. We don't have a macro model to forecast. And then I started thinking, well, what would be the number I'll come up with if I have to give, my ideas of where India's economy is heading. So I'm talking about a year ago, right? So the economy is coming out of the pandemic, and the question is, where will it settle? So there are two things that I came up with. One, I said my best guess of India's growth number is the average of 5 pre-COVID years, which is about 7%. So I said my best guess is 7%. The other was when I was looking at these 5 pre-COVID years, there was a year 2019-20 when growth slowed down to 4% and in the revised data to 3.7%. So that kind of was a bit of a confusion. So if I'm saying India will grow at 7%, that's the 5-year pre-COVID growth rate, then where is this 3.7 coming from, or 4% when I actually came up with this idea? And what does it mean for India's growth story or growth promise? Is there something structurally, did something structurally break down in the economy during that pre-COVID year that India cannot recover to a 7% growth? So that was the question in my mind. And there were commentators of two kinds. One who always believed that India will grow at very high rates because of its underlying strength and because of the reforms it has undertaken at 8% the moment we are out of COVID. And there were commentators who were saying that India has been in a multi-year structural slowdown. And I wanted to understand what is it that the data is showing. So this paper actually started as a personal query, a personal inquiry, basically. What is it that I'm seeing in the data? If Indian growth actually slowed down to 3.7%, what exactly happened? What kind of shocks did the economy phase for it to slow down to that level? What does it mean for growth coming out of COVID? So it's just a personal question that I started with. Initially, it was going to be a simple accounting exercise, and it remained actually that. So at one level, I'm a little bit humble about this paper, and I don't want people to judge me. I've written better papers. This one is not econometrically heavy. This one is just looking at the data from many different angles. But even so, the findings that we had were found to be interesting by people. And since then, those narratives have actually become a little bit calmer, those on the opposite side. So this was the motivation, really. Where will growth settle down? Growth has averaged mostly at 7% during pre-COVID decade. But then there was a year when growth initially slumped down to 4%, and it was downgraded further to 3.7% in the revised estimate. So we just conducted an accounting exercise to understand the character of the slowdown. Where was it concentrated, basically? And then we tried to look at the correlates. When it seemed that it's becoming a paper rather than an accounting exercise only, then we started digging a little bit deeper into trying to understand the correlates. The literature or the framework that we are using, very little really. I mean, the narratives that one we are hearing when I got interested in this paper. But if one has to really find the literature, then it's the literature on the correlates of growth, shocks that impact growth. There are papers on growth slowdowns and correlates of those. It also relates to the papers which point out at the importance of trade, external trade for growth, and the importance of financial sector for growth. So if one is looking for the related literature, that's the literature we have cited in the paper. So if we look at last 30 years of GDP growth in India, this is what it looks like. What we have here is average growth rate during 3 decades, for which we have the data here. Another way to characterize this growth rate can be that we put a linear trend on these 30 years. If you do that, you'll get a positive sloped trend line. So the growth has slowly but surely accelerated over these 30 years. Besides this acceleration, another interesting part is that it has become steadier. So the variation, it's a 1 standard deviation band that you are seeing here. The variation around this average growth rate has become narrower, which means that gone are the days when growth could be sharply either decelerated or even negative, or very large spikes. So growth has kind of stabilized. In another paper that I did at the World Bank, which was titled India's Growth Story, we have reflected on the various features of India's long-term growth, including this one. The steadiness comes from 2 things. One, that within sector growth rates have become more stable. So agricultural growth rate is more stable, manufacturing is stable, as is services. The other is that composition of GDP has transitioned towards the services sector, which in general has more stable growth rate than that of agriculture and manufacturing. So for both of those reasons, India's growth rate has stabilized. In that paper, we have other factors as well, including whether the acceleration in growth rate that we are seeing is accounted for by increased input use or productivity growth, whether it's spatially well distributed, whether it's sectorally well distributed, and so on. And there's some neat stylized facts there if you're interested. But today's paper is only about 1 year, which is 2019-20. And these charts are just to put the background around that year. So actually going back to this chart, if you look at this last year, 2019-20, the data stops there deliberately. After that, of course, there was COVID and recovery from COVID, etc., which do not need to be here. If you just look at this chart and you look at the growth rate in 2018-19 or a couple of years before that, the growth rate is around the average, 7% or above 7%. So when people talked about there being a multi-year structural slowdown. Looking at this chart, I was not convinced that it's a multi-year slowdown. So if growth in a particular year had accelerated to 8%, there had to be mean reversion. So anything that reverted closer to 7, I'm not counting that as a slowdown. For me, the window started only when it went below 1 standard deviation, which was 2019-20. So we belabor this point in different ways, that it's not a multi-year slowdown. The year of interest is 2019-20. That's when it falls significantly below the average growth rate of the previous decade. We do a similar exercise using quarterly data. So then, is it just a 4-quarter growth rate slowdown, or is it longer than that? And in fact, to be very precise, the growth slowdown started to take shape in the last quarter of 2018-19. So if I'm asked to look at the data, then I'll call it a 5-quarter slowdown again, rather than a lost decade or multi-year and so on. I don't want to name individuals, but in my mind, it's clear who said what at what point. And in a way, I was catering to these narratives from a very objective point of view, because I needed to understand myself about this slowdown. There was no audience as such at that time. So the next step was sectoral decomposition. Where is this slowdown coming from? If there's something structurally broken in the economy, then I would perhaps expect a slowdown across sectors and subsectors, right? Something is so badly broken, whether it's institutions, policy framework, shocks, lack of confidence, policy uncertainty, whatever it is. Some of the things can be quantified, others cannot be. But if it's a structural slowdown, I would expect to see it across most activities of the economy. So the first interesting thing that came out was just looking at the sectoral composition of that slowdown. The columns of interest are the ones highlighted in red. So here we just have 2 kinds of numbers: average contribution to GDP growth over 12-13 and 18-19, comparing it with contribution of each sectors to growth during 2019-20. So, these numbers, I just find it interesting in general to look at whenever I'm working on a slightly empirical paper, that agriculture contributes only 0.5 percentage points to GDP growth, whether we are growing at 7%, 6%, 8%. Well, 8% hasn't happened in many years, whether we are growing at 7% or thereabouts. Agriculture contributes 0.5 percentage point, right? And that's not a big driver of growth at all. During this year in question, contribution of agriculture was slightly higher. Agriculture has been doing surprisingly well last 3-4 years. Services sector, which is the last row highlighted in red, contributes bulk of India's growth, 4.25 percentage point during the reference period, which slowed down to about 3.9%. It is a slowdown, but it's not a very sharp slowdown, right? So the deceleration is only accounting for 30 basis points to growth. The bulk of the slowdown actually happened in what we call the industrial sector. So nearly 2.3 percentage point of growth rate. So we are talking about a slowdown of about 3 percentage point, right? Slowing from 7% to 4, broadly speaking. There's errors and omission as well, but let's think that we are trying to explain a deceleration of 300 basis point, out of which 2.2 percentage points of slowdown is in the industry sector. So that's interesting. Where is it coming from? So we dig deeper, right? The RAs working with me don't enjoy their life, because then I say, go back, dig deeper, see what is industry composed of and where is it coming from. Most of this deceleration was concentrated in manufacturing within industry. And you can see that here, nearly 1.7 percentage point worth of the turnaround is there. The other thing was, so started looking at the data in multiple different ways, using whatever is out there. We eventually also went to the high frequency data. To the extent that sectoral data is available at quarterly frequency, We also wanted to understand, was it a particular quarter during which the slowdown happened, or was it a year-long phenomenon? I could have brought in the last quarter of 2018-19, but did not. So here, all we have is average quarterly growth rate of the reference period, one standard deviation band around it, and then growth rate during the year we are discussing here, 2019-20, right? Which is the red line. So if the red line is below the standard deviation band, then it's significantly below the average of the previous quarters with the few data points that we have, which one can point out as a limitation of the paper. Now, let's look at agriculture first. Did well throughout. In fact, did quite well in the last quarter. And last quarter is the one in which COVID had started to strike. Services is all right. At least the first 2 quarters were pretty good. It's in the last 2 quarters that it became more subdued. Manufacturing actually did badly throughout, industry or manufacturing, whichever way you want to put it. So all 4 quarters were bad for manufacturing. So we got 2 pieces here and there. We could see the sectoral allocation of this deceleration. We can see that there's nothing really terribly specific about each quarter. But if anything, last 2 quarters, services are slowing down, manufacturing slowed down all through. What else? So within manufacturing, within industries, manufacturing actually is contracting, right? So big red flag there. Construction is not doing too well either, but the construction, the activity itself is, growth rate in this activity is kind of volatile to begin with. So very wide standard deviation band, but manufacturing is where most of the deceleration is concentrated. So now, having reached here, there's one more part of the story which I'll come to. So here we have looked at the GDP data from the sector side, right? Production side as it is called. There's another side which is the end use side, which is consumption, investment, G, X, and M. We look at that too. And in fact, some parts of the story will start building when we do that. So we have looked at one side of the story. Now the question is, just looking at this one for now, so what happened during the year? So now we are trying to put the dots together on whether there were specific shocks that hit the economy. And here I'm now using my knowledge of whatever I've learned about growth processes across countries. When growth slows down or when growth becomes negative, there is usually a distinct shock that impacts the economy. I've worked on sudden stops of capital flows and balance of payment crises, terms of trade shocks. Usually when growth suddenly slows down from nearly a good positive number to either contraction, or in the Indian case from 7% to 4%, growth rate is really halving, it's going down by 50%. There has to be a shock. And this was the other part of the inquiry. So we are looking for shocks, and we don't see any obvious shock that occurred. Obvious shock. Of course, eventually some things did occur. We don't find macroeconomic stability being compromised. What do we mean by macroeconomic stability? Usually we look at the current account deficit, inflation, fiscal deficit. At times we include exchange rate. Macroeconomic instability is said to occur when your current account deficit is very high at unsustainable level, inflation is very high, or fiscal deficit very high. So as macroeconomists, actually life at times is very simple. When you have to assess an economy, and this is my training at the IMF, you just look at 6-7 variables. You look at real exchange rate appreciation, you look at NPLs, you look at public debt, you look at bond yields, you look at equity market, and you can quickly say the economy is doing all right, or economy is actually on its way to blow because my macroeconomic excesses are being built, or is it already in a situation where it will have a crisis if it hasn't had as yet. So macroeconomics in that sense is very, very easy. About a dozen variables and you can, broadly speaking, tell how this economy is doing. So just a little anecdote. Recently, we were looking for a panelist at a conference that will happen at Columbia University later this month. And I was suggesting a speaker who's at the IMF, and Arvind Panagaria asked me, does he know enough about India? I said he doesn't have to, because the framework is very similar. He'll just look at these variables and he can tell us about India. So that is how these frameworks are, right? You can actually talk about whether a country is doing well or not by looking at a very simple framework. But anyway, so external shocks, the kind of oil price shock we have seen in the last 3 or 4 months, that's the kind of terms of trade shock that can impact an oil importing country like India. During this year, there is no capital flow reversal. There is no terms of trade shock on account of high oil prices. There are no geopolitical tensions or associated disruptions. So the kind of shocks we are seeing currently this year unfolding and all of these shocks can be important for a country like India. We didn't see any such shocks there. There were no economic, political, or policy shocks either, right? And you can define them in whichever way you want. Political stability, no new tax, no demonetization, no GST, all of these things had started to stabilize from this year. So we cannot attribute the slowdown to that either. I'm happy to take questions, if any, before I proceed.
So is there a possibility that maybe there were a shock which happened 3 years ago and which is happening with the case that?
Yeah.
Is there a possibility of such a shock thing having an effect?
Absolutely, there is. But the kind of shocks that happened 2 or 3 years before that, there's no reason to believe that they will have a sudden impact 3 years from then. So we also looked at the past. The shocks that happened were demonetization and GST. Those were the 2 big shocks, right? But for us to think that those shocks will have a precise impact 3 years from then, not a gradual build-up, is hard to reconcile with. The other thing, actually, a related thing that came up with was a lot of people commented on the paper and sent us their comments. So some of the people who have either served in the government or had served pointed out to tight monetary policy that happened beforehand. They said, but you're not looking at the impact it had on growth. I said, well, my framework is very, very limited. I'm looking at contemporaneous shocks because of the steepness of the impact. And then my counter to them was, if I'm not looking at the lagged effect of monetary policy, I'm not even looking at the lagged impact of demonetization or GST, right? So I'm at least consistent in my approach that the sudden decline in my mind means that there has to be something contemporaneous, but it's not tight econometrically at all. And because of the way the data is looking. If there is a slowdown consistently happening, that means there's something structural. Because of the suddenness, I'm just looking at shocks that happen at that time, right? Any other questions? But after 2-3 slides, we can take a break again for questions. So this is just how so we looked at nearly 20-30 variables. When I said, when you're looking at the economy, what exactly happened? I was not in the country in 2019-20, so I was not living that period of slowdown. I was just looking at it from a distance. In any case, the memory had faded by the time COVID happened, and 2 years after, COVID became the story. It had almost was not in people's radar. So inflation was, from historical perspective, history being the reference period here, was not very high, whether you look at CPI or WPI. It's not the place to discuss why these 2 series deviate so much, but I have views. I've been looking at them, again, to clarify my own thinking about why do the series diverge so much. But if there's interest, I can come to it. Current account deficit was less than 1%. So it's not that our external competitiveness was in threat. It's not that we were importing too much oil or that we were living beyond our means, so to speak. Fiscal deficit in this case is slightly higher than the norm, which can be interpreted not as that there was unsustainable fiscal deficit, But the fact that because the slowdown was happening, there was an effort to counter cyclically support the economy, but also the denominator was shrinking. So fiscal deficit as percentage of GDP, therefore, is looking a little higher, but cannot be the reason for the sudden deceleration. Interestingly, government yields were highly contained, no matter how you look at them, which means that fiscal sustainability was not being doubted by the bond markets. Equity markets seemed all right. Yes, there seems a slowdown, but not commensurate with the kind of deceleration of 300 basis points we see, especially in manufacturing sector. Now this is capital flows. For most part, they look all right. $5 billion average quarterly inflow during the year compared to $3.5 billion. FDI is good. Now, the sharp decline you see in the last data point, we have to hold on to that. That is COVID. This we saw in high frequency data. In my mind, COVID started from Q1 2021. Actually, COVID started impacting everything in the last month and a half. As I said, oil prices were $60 a barrel. Sounds like music, given that prices are now 85 to 90, had gone all the way up to 120. Volatility index of equity market looking very benign. Let's not look at the spike in the last quarter, which is COVID, which we look at separately in terms of contributor to the growth deceleration. So that was looking at the data I gave you. What I showed is a subset of the variables we looked at. We looked at, as I said, many different things. Then we started looking at the policy announcements to see that was something announced which just simply spooked parts of the economy. So, monetary policy meetings were held as scheduled. And I think in 3 or 4 meetings, policy rates were brought down sequentially by a good amount. And I'm forgetting what that amount was. Elections were held, which yielded politically stable government. Budget was announced. There was nothing in the budget that could be considered worrisome to yield the kind of outcomes we have. So we have a monthly, actually, timeline of political and economic events that happened. So we ended up preparing 2 different timelines. So if anything, it was during this year that a large reduction in corporate taxes was announced. GST had started to stabilize. There were state elections, which also yielded stable governments, and so on. It was only towards the end in March that COVID had started to take hold. So then we extended further. So we don't have too many clarifications as such. We have some data points. We have some understanding of the sectoral composition of that slowdown, but we still don't know what caused it. So we looked further, and here we started looking at the GDP from its end use side. And we started to zero in on 3 contributors to the slowdown: exports and the global trade volumes, banking and non-banking finance, and the impact of COVID. So this is the contribution of expenditure side components to real GDP growth. Now here what is interesting is, let's look at what is slowing down and by what magnitude. We do see some slowdown in consumption, that instead of contributing 3.9 percentage point to GDP growth, it's contributing 3.1 percentage point. Investment is broadly steady. Government expenditure actually increased, which is not surprising given that the slowdown was unfolding. But a big decimation that's happening is in exports of goods and services. So on the sectoral side, there is manufacturing. On the expenditure side, it's exports, which are slowing down, which are a turnaround of 1.7 percentage point of GDP. More than half the slowdown is happening here. So then we started working at two ends, right? Manufacturing and exports. And that's why we started looking at the global environment, both global GDP growth, but more importantly, global trade volumes of goods and services. And globally, trade was slowing down, global economy was slowing down. And there are implications one can draw from here for the current year, right? So this year as well, global growth is likely to slow down and global trade is being impacted by what's happening geopolitically. And in fact, the slowdown is both in goods and services and is usually sharper in goods than in services. And alongside the world market for goods and services, India's own exports are slowing down as well, much more sharply for goods than in services. And one can actually calculate the contribution of all this to India's slowdown, which is what we are able to do. We dug out quite a bit into India's export basket. That is it concentrated, whether geographically, oil, non-oil, different commodities, etc. So we see that India's not only slowed down in response to the global market, but its share in world exports also declined, which means the decline was sharper than what was happening globally. So domestic factors also contributed, not just the global slowdown in the total trade volumes. Let me ask for questions because some of you are getting lost. I know it gets tedious, right? So all presentations should finish in 20 minutes, but questions, please.
How much of this can be attributed to the inflation targeting framework? So there are debates about whether it is the framework that has really brought the policy down or whether that is a consequence of the slowdown in itself. So how would you really...
I need one more invitation. I have a full paper in inflation targeting. I actually wrote an op-ed in Economic Times last week in defense of inflation targeting. So you know my answer. Yeah, so that year, so inflation has been coming down for many years. Inflation targeting was put in place against a backdrop of double-digit inflation. And even before India implemented a full-fledged inflation targeting framework, it had started moving to a de facto inflation targeting kind of a setup 1 or 2 years before that. So going from the 10% somewhat sticky inflation down to our current, I mean, forget about last year or two when it's hovering at 6+. But there is a good amount of period in which when it was brought down to 4%. Now, again, some people have attributed it to a decline in oil prices, right? But if you do the decomposition, it's not just oil prices at all. There was a period when monetary policy actually was tightened quite a bit. And so it's a slightly long and dense paper, but we have looked at each and everything, inflationary expectations, reaction function, different kind of inflation series, to get to the question that you're asking. So I believe that inflation targeting as a framework has anchored expectations, but in order to come to this stage where expectations are anchored, it had to be tightened, perhaps much more than was warranted by output gap, so that inflation could be brought down to a level which was actually, it went below 4%, right? So these current or ex-policy makers, when they asked that it contributed to the slowdown, perhaps it did. But then during this year, the policy was eased quite a bit. So what I'm trying to say is that my response is that inflation targeting as a framework had a role to play, not just in bringing the inflation down, but also keeping it anchored even in the current time. One paper that I would really like to do is when COVID is over and then when the current inflation acceleration episodes are over, to ex post compare inflation targeting countries with non-inflation targeting countries to see whether controlling for the fiscal stimulus or other factors within the economy, supply side disruptions, was the increase in inflation less or more for inflation targeting countries, and whether those countries were able to bring it down more or not. And I don't know what the answer would be, but the question is interesting. I really want to understand how is this framework working across countries. Now, there are nearly 50 countries which are on inflation targeting. So there can be a good control group and treatment group, perhaps, and perhaps not, because most of the countries that matter are on inflation targeting. So then I don't know whether, it would be easy to do it. But yeah. Any other questions? I mean, I don't know what value it would have added. One could look at it, but one looks at IIP because it's a monthly series. So once you get actual manufacturing data at a quarterly level, then it does not play a role. So it might have been in those 20-ish variables we looked at. But two things about IIP, as I said first, it's a leading indicator of manufacturing, and that's why it's used before the quarterly becomes available with the lag. Second is, it does not correlate very well either. But to answer your question, I didn't know what value it would have added, right? But one can look at it. I again don't know what it would do. So let's take another break after 3-ish slides. Yeah. 7, 8 years. Yeah. We did that. So there is one table which I thought you guys might make fun of. What is this table all about? In which what we did was to quarterly data. I have hidden that slide or deleted that slide. So 32 observations, 8 years of data, right? And then we have dummy for 1 year at a time to see which year is significantly different from the average of the rest. I don't know whether that's the exercise you have in mind.
Yes.
And there we only find 2019-20 to be significantly different. It's in the paper, actually. There is this table in the paper. Because the idea was really to come up with something credible, right? So you look at the data in many different ways so that somebody cannot say that your exercise is selective. So we looked at that too. So for example, the chart, we had that quarterly chart. Think that we are doing the chart for each year. And we're asking ourselves whether it's below or within the standard deviation band, right? So when we do that econometrically, only 2019-20 is below that standard deviation band. Okay. So yeah, exports slow down to almost all destinations, oil and non-oil. Quite a bit of work we did on it. And just to make sure that there are no hidden trends that we are missing out. So what we did was to keep the story somewhat manageable. We put all of these things in the appendix. Those who wanted to see whether we have done a thorough job, many of these things are in the appendix of the paper. Now it's a little exercise with 20 years of data to see how does India's growth rate correlate with global exports growth or global merchandise exports growth. So there is a neat positive correlation. And having established that correlation, then we stuck in the dummy for 2019-20. That once we control for the global volume of trade, growth in global exports or merchandise exports, what happens to our dummy? So look at column 3, where if, now this is, compared to 20-year average, which is 6.6 percentage point, growth in 2019-20 is 2.5 percentage point below. But once we control for global growth, either of total exports or merchandise exports, that coefficient becomes much smaller. So that's the extent. The difference is the extent of slowdown that's being explained by the global slowdown. The other piece of our story was financial sector. Now, this is not the year in which banks had a huge problems. Banks' NPL crisis had been unfolding since 2013. But this is not the year when that crisis took any new form or it got aggravated. What happened during this year was the NBFCs and housing finance companies had almost a complete collapse of credit. So by looking at the banking sector, not finding anything, expanding the scope of inquiry, we started noticing things in the NBFC sector. So just look at nearly 0% growth of credit from housing finance companies and a significant deceleration of credit growth from the NBFC sector. So when we look at this segment, and again created a timeline to understand, these are not the things we could do very neat econometrics on, without even knowing the hypothesis that we are interested in. So when we started, we didn't know the hypothesis. And now one can actually look at the data, firm level data in manufacturing, those which rely on credit for NBFC versus elsewhere, export oriented unit, and then see whether these factors mattered for their growth during 2019-20. But when we started out, we didn't even know that these are the variables we're interested in. But when we put together this timeline during that year, there were a number of NBFCs which were failing, which were being put into resolution, for which withdrawal of deposits was being curtailed. There was a crisis of the NBFC sector. And we have listed which all companies actually went under. So there were cooperative banks, there were housing finance companies, there were IL&FS credit, IL&FS crisis, all of that happened during the year, which interestingly had a large impact on the slowdown. And this is where one can also start drawing the link between manufacturing sector slowdown versus the correlates that we are talking about. So credit to manufacturing sector is important from this segment. That is one part of it. The other part is consumer finance, right? So a lot of manufacturing purchases, these being durables, require availability of credit from the NBFCs. When this credit slow down, the demand, and through that, the production of manufacturing slow down. So we take, we make a lot of effort to look at what exactly was happening to the segment, and this is what is listed here. So a little bit of an empirical exercise that we did to quantify the impact of these two factors, trade and global trade environment and financial sector, importance of financial sector. We divided up manufacturing subsectors into two groups. Those which are more dependent on external finance and those which are less dependent on external finance. I'm sure you have seen this paper, Rajan Zingalis, and its evolution after that. And similarly, we divided up about 12 manufacturing sectors into those which are more export-oriented and those which are less export-oriented. And the numbers we have here are the growth turnaround during this year. So, manufacturing sectors which are more dependent on external finance had a larger slowdown than the ones which did not. And it's even starker when we look at the export intensity. Sectors which depend more on external trade or which export more had a larger turnaround, larger slowdown in growth than the ones which did not. So, it wasn't, so I'm forgetting, not too far from 50-50 it was not that 10 in two and 2 in the other, because that would have been, so it was more like 40-60 or 50-50. One more thing, when you're dividing these up, you do it in a number of different ways. Your cutoff could be at the median, right? So 50-50, it's actually up to you. Why am I saying 40-60? It's up to you where you draw the cutoff. The cutoff can be median. So then but what I usually do is to get the sharpest contrast and to make sure that it's not subject to how I'm doing the cutoff. Often I take top 30 and bottom 30, right? So that's one of the two. I don't think it's median because of the differences being. The last one was COVID, actually. And why we got interested in COVID is because of this chart. So again, we had, during COVID, actually, everybody started tracking these mobility indicators and all kinds of high frequency indicators. So the kind of decline you see starting 2021, actually similar kind of declines were evident in the data in the last month. This is all monthly data. So which meant that COVID started hitting the Indian economy before we saw a 24% contraction in the first quarter of the following year. So this is what we look at and we try to quantify the impact. Now, if you remember, actually, the official lockdown was announced only on March 22, right? So even if we see these sharp declines, the idea is, how does it matter? It's only 8-9 days. So in presentations, I say the difference that a week can make. And it was an interesting exercise to do it this way. If you think that economic activity is uniformly distributed throughout the year, then in any 1 week, we are contributing 2% to GDP, right? And if the 2% has a decline of nearly, it declines by nearly 50%, or let's assume even by 24%, because that's the slowdown, that's the contraction we saw in the first quarter when we could measure it. And you apply these two together, then nearly 50 basis points decline in growth can happen even during these 8 days, right? Everything came to a standstill. That was the harshest of the slowdown. Nothing moved except for poor migrants who were going back to their villages or wherever they came from. So 50 basis point worth of slowdown is a conservative estimate because people have started moderating their activity even prior to that. In fact, I was told by my NCR colleagues that starting sometime in February, they had started to do work from home, which means that much less activity. So it's a conservative estimate. So out of those 300 basis point worth of slowdown, turnaround, nearly 0.5 percentage point is COVID. So in the end, I don't know what one does with this exercise. So you do all of it, and you realize that 3 things happen: global trade volume slowdown, global growth slowdown, India's elasticity with respect to global exports growth is about 1, a little more than 1, which means that when there is a slowdown globally, we slow down even more. Financial sector, NBFC crisis took a toll on growth. Cannot quantify, except if we look at those charts we had done on external finance dependence or not. And COVID happened. Now, what does it mean for, let's say, our understanding of the growth drivers of the Indian economy? And what does it mean for growth for this year? What are the kind of factors we should be watching out for? So yes, global trade and growth outlook is worsening. Hasn't worsened a whole lot, but people are saying there'll be a global recession. So let's wait for that. India's exports so far are holding well because, there is also some pent-up demand that is getting fulfilled globally. But there's no crisis in the financial sector. Thank goodness for that. COVID has receded. If anything, there are contact-intensive services which have not fully recovered, but which will recover, which are continuing to recover, which can add to growth. But then there are other factors which we did not have in 2019-20. Capital flows and policy tightening all around is having an impact on India, which can have an impact on growth. Terms of trade, which had deteriorated quite a bit, but have started to improve now, will have a bearing on growth. So what is the number for this year? I don't know. I'm still maintaining 7%, but it could be between 6 and 7. And it really depends on how the global economy unfolds. So this year, again, global story is important, both from the real side as well as the financial side, capital flow side. This is it. Questions?
Thank you. That was a fascinating presentation. We'll take questions from the audience. There are a couple of people who are online also. They might also ask questions. But I would like to ask a simple question in terms of you've been looking at the immediate pre-COVID period in terms of the growth slowdown. But when you're thinking of let's say the next 5 years or the next 10 years, what do you think of these drivers of growth in the medium to longer term?
Yeah, Zanke, that's a $3 trillion worth of question. That's the size of the economy. My guess is as good as anybody else. But if you ask me what is the official position that I often take and will be taking going forward, and actually also reflected on it in a column for Project Syndicate, for which thankfully I didn't get into trouble, but could have. Structural factors are very, very important, right? And there's so much to be done structurally, not just in India, but any economy which aspires to grow for decades and aspires to become a solid middle income country. So reforms or structural strengthening of the economy, let's call it this way, because reforms has become such a cliched word. And some people corner you. What do you mean by reforms? Aren't we reforming enough? So let's call it the structural drivers of growth. There's so much that needs to be done. Our financial sector needs to become more growth supportive, more efficient, more modern. When you look at the employment requirement of work and activities, it's becoming less labor intensive at one level and more skill intensive at the other level. That needs to be, it's an ongoing process, basically. When it comes to deepening on the real side with the global economy, that's important. Global economy is 30 times the size of a domestic economy, and all those factors. So those factors are very, very important. What we have done well is the short-term management of the economy, which is the macroeconomic stability that we have been able to ensure despite COVID. I think that is a big plus. And that's one among many factors which impact growth rate, right? So I think there are a lot of underlying strengths of the economy, which we all have been reading about: a young economy, a large economy, a diversified economy. So my comparison often is, let's say, with small countries, which depend on the export of one or two commodities. Chile comes to my mind, or other commodity exporting countries. How the economies do is determined so much by the terms of trade. But India has enough balancing activities within the economy. So global growth is slowing, financial markets are volatile, but along with that, oil prices will decline. So that's a natural cushion we have, because we are so large and so diversified that that's the strength of the economy. But a lot more things, as I said, on education, on skills, on manufacturing remains an unfulfilled dream. Manufacturing, producing at scale is not easy, we are realizing, for the last 30 years, right? So whatever it takes to become globally competitive in manufacturing, you have to do it all. And just because we become competitive in one part of the production process does not mean that we become overall competitive. All of those things are very, very important. When it comes to macroeconomic stability side, we have done well. And that's why I defend inflation targeting. Frameworks are better than discretion, especially when you are an emerging market, an aspirational emerging market, which is now also open on capital account. It's important to have definite frameworks in mind. On that, I think we also should have now a fiscal framework that needs to be rethought of. The macroeconomic stability that we are taking for granted, and if we want to continue to think of it as a strength, then fiscal frameworks also need to be strengthened. So next decade, potentially certainly there. What would be the outcome? I don't know. I mean, I'll say 7% from next year. But a lot depends on how we manage the process.
So there are two questions from the online audience. So there is Rishabh Atre who has asked about, so he thanks you for a wonderful presentation by the stalwart. So we are seeing a lot of uncertainty in the world around after the war. Next year will be out of the base effect. So how much extent PFCE, fixed capital formation or trade contraction will affect the growth with respect to the 2019-20 if inflation persists?
Right. So my sense that the two parts of the question, PFC, is it consumption or is it capital?
Private consumption expenditure.
Private consumption expenditure. I thought it was about capital, which was easier. So first, inflation, I feel, will be tamed in India in about 6 months. It's not just that I'm rehearsing what the RBI has been saying, but primarily because of the base effect of inflation, right? So current inflation numbers include very high oil prices, which have started to come down. So just in a purely technical sense and inflationary expectations being anchored. As far as personal consumption expenditure is concerned, I'm not worried about them in two ways. One is that there's still pent-up demand in the economy. Second is continuing support from the government. So despite the fact that our debt and deficit numbers are very high, I think there is a broad understanding that this is not the year to start consolidating them. So both of those things will support personal consumption. If the question was about private investment, then my sense just by talking to a handful of private sector investors is that last 2 to 3 years, they have been deleveraging, and they are now at a stage where deleveraging is more or less complete, and they will start investing. A lot will again depend on the global ecosystem and the domestic ecosystem. But the fact that they were deleveraging past 2 or 3 years, I think there is scope to grow more.
So there is one more question. We'll just take one question from the online audience and then we'll come to the offline. So the Deepak Patel is asking, is it time for the government to start thinking of policy related to export-linked incentives instead of production-linked incentives going forward?
I haven't thought about that question, but in my mind, when I think about competitiveness and being able to export a lot more globally, it's from 2 or 3 different angles that I think about. So global trade growth is slower than it used to be. And when you're trying to export more in a slowing market, you're absolutely trying to displace an existing exporter, which means that you do not have to become just absolutely more competitive, but you have to become more competitive relative to them. So it's a lot of work that needs to be done. Now, whether you can become competitive through fiscal incentives, and if so, what would be the extent of that incentive? I don't know. I would like to work through the first principles, which is that let's just become more efficient and more competitive, whether there's support or not. Because the support can be very temporary, right? And also look at our fiscal, which I didn't have time to get into, where we are fiscally and who all can we support and for how long. And so if we do export link incentives, do we discontinue production link incentives? We just started a year or 2 ago. So I don't have a definite answer. I mean, a first best would be to become more competitive on first principles basis, which we are in services, by the way.
So my question is something that in this paper, the causality seems to be running from that exports and there was NBS crisis. That's why there was a slowdown in manufacturing and construction. But what if we do a year-wise analysis of 17, 18, 18, 19, and then we see that there is a gradual decline happening, then we can say that the causality is running in other. There would be a problem of simultaneity.
So just tell me, so a gradual decline happening in what? Exports and NBFC?
So what we are seeing is that there is a visible decline in manufacturing and construction in 1920, but what we can't see that the gradual decline or the figures for 17, 18,
Yeah,
18,
Yeah, good question. I didn't show them here, but the decline is sudden, starting Q4 18-19, even at a sectoral level. I showed that at GDP level, no? No, I only showed it for 4 quarters. You're absolutely right. But the figure that we had for GDP, I think that was my 3rd or 4th slide, quarterly GDP, we see a decline for about 7 or 8 quarters. And then I defended that the first 2 quarters are just mean reversion. And the last 5 quarters in which it declines below 1 standard deviation band, right? Similar pattern you see in the sectors where the slowdown was most concentrated, which is manufacturing and exports. So yeah, so those connecting the dots we did. Yeah, it was not seen in the previous years.
Professor, so a lot of the MSMEs are involved in the export sector, and a lot of them gain finance from non-banking finance companies as well. So something of a survey of for MSMEs can be perhaps depictive of what was happening on the ground. I mean, that could explain what was driving this fall in industrial fall in the manufacturing sector as such. It's just a suggestion.
You know, it's a good suggestion. 2 things on that. First, I do keep hearing that MSMEs export. I haven't seen any evidence. We do hear that they generate employment and they export, but I haven't seen evidence. I'm sure they are great and they contribute. It's just that I haven't seen the evidence. Yes, surveys are useful, but doing surveys is very expensive. Somebody has to be interested in the surveys. But I think absolutely. I mean, if somebody was doing it more seriously, rather than just looking at the secondary data, would have said that I'll go and ask what happened in 2019-20, why did you slow down? But actually, just to defend, what we also did was NCR conducts a quarterly survey, business expectation survey. I think I did look at that, but you know, one more challenge with the surveys are that their average results at times make sense, but firm level results are all over the place. So I don't think I found something.
There's a lot of data regarding GST filings of MSMEs as well, which is coming up. So a lot of micro data is also available.
Yeah.
I mean, perhaps
I think that would be very useful. You're absolutely right. You're absolutely right. Yeah.
So if any other questions?
So I still don't get it why you are saying it couldn't be reasons couldn't be attributed to like previous years, like demonetization could be one factor for this. Like if I say after demonetization there was a contraction in construction sector, and construction sector has a lot of money from NBFC and non-banking financial company. That's how it collapsed, and it could be attributed to the.
Absolutely. So demonetization happened in November 2016.
Yes.
Where do you think the effect would be most concentrated? 2017 calendar year, right?
Yes, or it could be gradual.
Or it can be continued, right?
Yeah.
So I think that's the chart I need to share, or the quarterly data. It's very easy. It's quarterly data. So did the decel? So you're saying it's a part of a potentially a part of a slowdown that started after November 2016. That's the hypothesis. And I'm saying that's not what I saw in the data, but I'll go back and check that it's correct, right? The other thing. So if you look at the contribution of construction to the slowdown during this year, it was very small. So continued slowdown of construction from November 2016 can be a part of the story. Okay. But quantitatively, it's smaller.
No, but I mean NBFCs are related to construction.
NBFCs did terribly well in the previous years. So what happened in the NBFC sector was, because banking sector was not doing well and they were not lending, they started lending to NBFCs, which in turn lent to everybody else. So NBFC's growth, and it's in the paper, is 25%.
Which year?
These are the years. I can't be held totally accountable, but broadly speaking, 17, 18, 18, 19. Just go and see the 3 years actually, maybe even 16, 17. So 3 years prior to 2019-20, just look at the growth rate of credit by the NBFC sector as well as HFC. So nearly 25% growth rate. And there's a correction. It collapsed in 2019-20.
So maybe we can take this bilaterally offline. We can.
No,
so
but
we're
your
running out of time.
concern I can understand
Hmm.
from what I recall. Those 3 years, credit growth by NBFCs, HFCs was very high. There should be a table in the paper. If not, I'll share the data. We painstakingly put together everything from hard copies and whatnot, right?
Thank you. Thank you to the audience. Thank you to Dr. Gupta for a fascinating presentation. Thank you everyone for attending.
Yeah, which is good. We still have it.